Jazeera Capital. It is my pleasure to welcome you all today to Leejam's earnings call for Q3 2025. With us today, I'm pleased to welcome on the call our panelists, the Chief Executive Officer of Leejam, Mr. Abdul Nideh Al Nimr, Chief Financial Officer, Mr. Asim Al Atas, and finally, Mr. Saud Al Ragas, the IR Manager. We will start the call with a presentation from management before opening the floor to participants for a Q&A session. I will start by handing over to the Group IR Manager, Mr. Saud. The mic is yours.
Hello, everyone. Do you hear me well, Fahad?
Yes, please go ahead.
Good. Hello, everyone. Good morning or good evening, wherever you are. Welcome to our Q3 earnings call. Before I hand over to management, we have our CEO Abdul Nimr and our CFO Asim Atas. I just want to direct your attention to the disclaimer slide before we start. And now I hand over the call to our CEO for an opening remark. Mr. Abdullah.
Thank you, Saud. Assalamu alaikum wa rahmatullahi wa barakatuh. Good afternoon, everyone. Leejam year-to-date sales has grown by 15%, driven by improvement in mix, volume, and price. During the year, we shifted subscription mix to short-term, arriving at 70% the subscription during the first 8 months. The like-for-like revenue per center saw a slight decrease, which was mainly due to change in the subscription mix coming from the deferred revenue. The non-like-for-like revenue per center grew significantly by more than 40%, showing strengthened momentum of ramp-up. Like-for-like EBITDA margin decreased to 49%, mainly due to decrease in revenue, increase in staff, and maintenance cost as more get refurbished. The non-like-for-like EBITDA margin increased to 42%, which driven by the increase in revenue. Some of the like-for-like hubs shows signs of slowdown due to issues related to parking, capacity, and quality of services. We are refocusing the quality of services, which changes to our in-club structure to ensuring alignment between the staff KPIs and customer experience. We are also reprioritizing centers rollout in Q4 and in 2026 to ensure operating model alignment and gradually elevate pressure on the margins. Thank you.
So now we'll take you, our CFO will take you through the presentation, starting from the highlight. Mr. Asim.
Thank you, Saud. Thank you, Busara. Good afternoon, everyone. I think the most key highlights on the performance, mostly the increase in revenue by 9%. We have a slight drop in the gross profit and operating profit, which we'll cover in the next slides. EBITDA stood at 200 million for the Q3. And the net adjusted profit at 83 million consolidated, including the results of the subsidiaries. In terms of number of centers, we have 11 additional male centers and 11 female centers. This will give us a total of 148 for male, 66 for female. Total big box will stood at 170. This is additional 19. And Express stood at 44 with additional 3. In terms of number of members, we stood at 532,000. This is a 5% increase. In terms of total visits, we have a strong demand, 9% increase in the number of visits. GX classes also grew by 22% with a total 114,000. Attendance also was stable with 2% increase. Total refurbished centers was 16 centers during the period. So the total number of centers added versus September last year is 23. But if we compare with December Last year, this is 11. The movement between the two periods, as we can see, most of the focus was in the big box female, which will have an impact on the female results, obviously, given the ramp up. A total number of members movement, as we can see, there is a 5% growth versus Q3 last year. The average actual increase is around 10%. In terms of number of members per segment, pretty much 4 and 5% increase versus last year in both male and female. And in terms of, that's in terms of total number. In terms of per center members, the drop is mainly due to the new centers that were added, which is expected because of the ramp up. As we discussed during the previous calls, we said we will refocus the product mix during the next period toward the shorter term, as you can see on the left hand side of the slide. The first 8 months, the short period products, which is 3 months and 4 months and 1 month, went up than comparing with last year. In Q3 specifically, and more precisely September, we usually focus on the 12 months. And that's why you can see the quarter is slightly better than last year in terms of short term, but still there is a focus on the 12 months given the momentum that we went in Q4 and Q1 due to the low season nature of the business. We've added the, we get a lot of questions around the cannibalization and movement between the brands, and this is to assure you that over the last almost 8 quarters, the net movement between the brands was positive. As you can see, the upgrades were higher than the downgrades. So on net basis, we are higher. This is just to, answer any concern with regards to cannibalization between the brands. On the left, on the right-hand side of the slide, we wanted to show you the price mix volume analysis. This is for the sales, not the revenue, just to highlight. As you can see, year-to-date wise, we have pretty much even increase between price and volume, and there is a positive impact because of the mix. If you think about Q3 versus last year, as we can see, this is the price and mix impact, mostly with a very minimal volume impact. And if you compare it with the same year, but previous quarter, it's obvious because of Q3 impact and the National Day sales impact, which usually has a higher discount versus Q2. That's why the price impact was negative. However, as usual, mix and volume impact was high. So revenue grew by 9% for the quarter versus last year. Gross profit in terms of margin, slight pressure still coming from the new openings. EBITDA margin likewise because of the ramp up as well as the increase in SG&A expenses. And the adjusted net profit in terms of margin stood at 19% versus 24% in Q3 last year. Pretty much the same story for the 9 months picture. Revenue per center, like for like, as mentioned by the CEO, there is a slight pressure on the like for like, mostly because of the mix, as well as the deferred revenue impact that is coming from last year. But again, it's not very significant drop. I think the positive note here is that the non-like for like, as you can see, and as we mentioned during the previous calls, it shows a strong momentum due to the mix of pre-opening campaigns, as well as the better selection in terms of location. If you think about the EBITDA margin as well, like for like haven't been affected a lot. Most of the impact here is due to the slight drop in the revenue, as well as the mix in the change in the mix. The quarterly look of revenue and net profit per center is pretty much stable. Most of the pressure is coming from the new clubs opening. We stood at 2.1 million for the quarter. This is slightly lower than last year's Q3 results, as again, because of the ramp-up issue. This is the fitness time performance only. We have excluded the consolidation results to remove any dilution. Same story for the bottom line. Most of the pressure is coming from the product mix change as well as the new openings. In terms of balance sheet, leverage is still stable at 1.7. Current ratio improved during the period due to the improvement in the working capital and strong cash generated. The return on equity as well as capital and capital employed were trending downward because of the pressure on the profits over the last periods and the back of the higher number of openings over the period. For the cash flow, I think overall we have a strong cash flow with net addition of around 165 million, growth of around 52% versus same period last year. In terms of free cash flow, I think overall it's positive due to the decrease in the capex spend as we get closer to delivering our targeted number of openings by the year end. I think the movement on the other items are pretty much stable. Cost of revenue, absolute wise, grew by 17%, driven by the increase in number of centers, but we still maintain the cost per center at 1.3 for the quarter. Obviously, there is still some pressure coming up from different items, whether it's the lease or the higher consumption, but we try to elevate it through other means. G&A grew by 7% versus last year. The decrease per center is mainly driven by the increase in number of centers. Sales and marketing expenses grew higher than I would say, the historical average, mostly due to the higher competition in social media. This is specifically for the quarter, but we do expect this to normalize in the next periods. In addition, there were a couple of awareness campaigns relating to specifically the new app that was released during the last period. Pretty much the same results for the 9 months period. Cost per center stood at 3.6 million for the period. G&A pretty much stable at 0.5 million. And again, there was an increase in sales and marketing because of these one-off campaigns. There was an increase in loans as a result of a couple of land acquisitions strategically chosen, whether for existing locations or new locations. In terms of deferred revenue, this is the highest balance we've ever achieved at 620 million. This is supported by a strong member growth despite the shift toward the shorter term subscription during the period. Yeah, that's it here. This is the lease expiry over the next 5 years. We get this question a lot. So over the next 2 years, we have around 9 locations every year, but they are still under negotiations. I think there was delay in concluding them because of the recent change in the law, so people are still haven't yet decided. We'll update you as we move during the next year. I I think Riyadh is around 25 out of this 51 over the next 5 years. In terms of number of openings, we expect, so we are revising the previous guidance, which was 32 to 39. We are revising it to be 14 to 22, mostly driven by delays that we've seen in terms of licensing, as well as some delays from the construction side. But definitely we'll update you if there is any change, but this seems to be the more accurate number from here until the year end. We are obviously still committed on the 250. The only difference is that instead of the majority of these clubs opening in Q4, they will mostly shift to Q1 next year. In terms of deferred revenue pipeline, this is the outlook over the next 4 quarters, which gives us a very strong head start comparing with the same position last year. And hopefully with this in the sales of the next period will give us a good start in the next year. I think project pipeline, as I mentioned, we are still committed to the full 250. We have also, I think, yeah, for Q4, and we expect revenue to grow between 11 to 13% versus Q4 last year. Gross profit margin, we expect it to be maintained versus Q4 last year. And as a result, bottom line growth would be between 20 to 25% versus Q4. This is based on the deferred revenue balance we have and the sales expectation we expect during the next 2 months.
So Fahad, now we can open the floor for Q&A.
Thank you, panelists. Sure. Thank you, panelists. Ladies and gentlemen, we will now commence with the Q&A session. You may raise your hand by pressing the hand icon on your screen to speak with the panelists, or alternatively, you may drop your question onto the Q&A chat box. With that being said, for this session, please limit your questions to just one at a time so we may satisfy as many questions from participants as possible. You are, however, more than welcome to join the back of the queue if you have a follow-up. So without further ado, the Q&A session is now open for one question at a time. And our first question comes from the line of Saud. Saud, your line is unmuted. Could you please unmute yourself and go ahead?
Yes, hi. Am I audible?
Yes, you are.
Thank you, Jazeera and the management for the presentation. I only have one question regarding the gross margins. So basically, last year, the total gross margin for the year was almost 41.5%. I understand that you just guided for fourth quarter gross margin, but just for us to understand, what is the expected full year gross margin for the company in 2025, and what is the expected gross margin in 2026?
Thank you, Saud. The change in the gross margin, as you know, was mainly driven by 2 reasons. The pressure that is coming from the new openings, which have 100% of the cost, but a fraction of the revenue, which takes time to ramp up, as well as the change in the product mix. So that was mainly the reason for the change in the gross profit margin over the last period. And that's why, as a tactical move, we've shifted our focus over the last 8 months of the year on the shorter period products because it has a higher yield. You know, our margins, unlike any other industry, it's an inverted formula. It's a fixed cost model. Any change in the revenue or the product that brought that revenue will have an impact on the margin. So it's really not that easy to predict because the product mix is also not something that you always control. We try to control it by the way we design the campaign, the way we design the incentive scheme for our people. But at the end of the day, people reaction and volume would make the final call. So everyday sales counts. So it's not really easy to predict, but whatever I shared for the Q4 is based on our best knowledge and the deferred revenue balance that we have on hand.
Thank you, panelists. Our next question comes from the line of Abdullah. Abdullah, your line is now open. Could you please unmute yourself and go ahead?
Thank you for the great presentation. This is Abdullah Brady from Emirates MBD Capital. On slide 11, we noticed that on the chart on the left-hand side, it shows the downgrade and the upgrade as a measure of cannibalization, but it doesn't show that the number of membership that are gained by new centers that are expensed from old centers. So if you do have this information, it will be a better measure for cannibalization. And in the same slide, we notice on the right-hand side, which is the year-over-year growth in sales, we notice that the volume is not too much, and most of the increase is coming from the mix impact and the price impact. So can this be the real measure of the cannibalization? This is the first two questions that I have.
Thanks, Abdullah. We look at our business as one cash generating unit, to be honest, even though there are different centers, but they complement each other. That's a fact. Now, with regards to cannibalization, we do have respect to distance and radius between any old and new center before we proceed, and we rarely see cannibalization from that end because it's a location game at the end of the day. So if someone will gonna shift from one center to another, is most likely because the new center is closely located to his office or so we have much less worry with regards to cannibalization between the centers. And I think a good measure of that is the like-for-like revenue. We are a 200 plus gym company where almost 80 of them were open in the last 3 years, and you still see the revenue of the like-for-like pretty much stable. So we are not really that much worried on that end. Most of the worry is between the different brands, and I think this is clarified here. With regards to volume, yes, I mean, first of all, let's not forget that we've increased the prices by 5% by end of Q2. So we did anticipate a drop in the number of units as a result. But luckily, there is no drop in number of units over the period, which is a positive sign for us. At the end of the day, we are a lifestyle product. Demand is slightly lower than what we anticipated and what we budgeted, but we believe this is something temporary and not something fundamental.
Thank you, panelists. And a kind reminder to participants to please limit your question to one at a time, at least while we have a lot of questions being piled up at the moment. With that being said, we'll be taking the next question from the line of Osman. Osman, your line is now open. Could you please unmute yourself and go ahead?
Hi, this is Usman from Seco Bank Bahrain. I have one question on the sold memberships slide that you have shown. So it seems like in third quarter 25, the 12-month membership has a higher contribution versus last year. And generally the 12-month membership yields are lower. So just wanted to clarify, would that mean that moving forward, there will be a decline in per member because of higher contribution from 12-month membership?
Thank you, Osman. I think we've mentioned before that we're still looking for the sweet spot. The company historically had a legacy of 70% plus short-term members. Strategically, it's much sustainable to move for a long-term product. However, given the difference in yield, as you mentioned, between the products, we don't want to move all customers to a 12-month subscription because this will gonna impact our margins. That's why we try to smoothly and gradually balance the two. So try to maintain the margin while shifting customers gradually to a longer term product. That's the ultimate goal we want to achieve. Now, given that there are other reasons affecting the margin currently, like the number of openings, it's not clear how much impact will come from there. So I think once the number of centers stabilize and ramp up happens, we will see where is the sweet spot that we will get to. It could be 60-40, it could be something else, but as long as we maintain growth, sustainability, and maintain and improve the margin.
Thank you, panelists. Our next question comes from the line of Muhammad Saad. Muhammad, your line is now open. Could you please unmute yourself and go ahead?
Thank you. Thank you. This is Mohammed Saad from Al Raji. I just have one quick question. So your G&A, general admin expenses, increased on last year's base. And last year in the third quarter, it was already elevated. Just to give you some shares and numbers, in the first 2 quarters of last year, the general admin was around 31 million. In the third quarter, it was 40 million. And now you are sharing that it's in the third quarter of 25, it was around 43 million. So should we expect the second half of the entire year for 2025 and for going forward as well to be always elevated as far as the general admin is concerned? Is this a new normal now? That's my one question.
Thank you, Mohammed. Over the last couple of periods, we had a couple of one-offs items during, as part of the SG&A. There were a couple of consultants that were engaged in different topics. The company was in a different size over the last and we grew over the last 3 years. So there were a couple of changes and on the org chart as well as on the system side. So generally, no, we don't expect to keep increasing the SG&A, but there were a couple of items that were spent during Q3 and as well during the last 8 months. But yeah, I don't think this will gonna keep increasing as we grow. I think we target to reduce it down the.
Thank you, panelists. We have some questions. Sorry, go on.
Rahim, just
Yes.
to get a fair representation, can we get, there is a questions in the Q&A or chat, can we get some of
Yes,
it?
sure. Yeah, I was about to move on as well. So we have some of those. I see there are 2 refresher questions, so I'll start with those. Hamad was asking if you could please repeat that out of the 51 lease contracts that will expire, how many of them are in Riyadh?
25.
Thank you. We have another refresher question from Rabi' asking, could you please repeat your gross margin guidance for Q4 25, full year 25, and 2026?
We haven't given any guidance on next year yet. We'll see how it goes. But in terms of Q4, it's expected to be around 44, hopefully. Again, this is dependent highly on the sales that we will continue to perform during November and December.
Clear, thank you. So we have a question from Ariba asking if you could please elaborate the licensing issue that you faced for the new gyms. Are there any companies also facing this issue?
Sorry, on the previous question, the total year margin would be close to last year, hopefully not that much lower. On the new question again, licensing?
Yes, asking what was the issue and are other companies also facing the same issue?
No, these are regular civil defense and municipality licenses for every commercial activity. There is no issues. It's just that, some snag list and some requests that need to be clarified as usual. We always, and this always makes it difficult to predict the exact number of openings during the year.
Clear. Thank you. We have a question from Abdulaziz asking that given the increase in staff and maintenance costs, are there any measures that are taking place to manage these costs? Will there be a self-service kind of concept? If you could share anything on that.
As you know, we grew our membership base almost by 100% over the last 3 years. And most of this increase came in the existing clubs. So in order to maintain the service level and cleanliness and hygiene and security and all of this, we had to spend there. That's one thing. Second thing, there was a change in the regulation in terms of lifeguards. So I wouldn't say change, but more strict in terms of implementation. So we had to equip our big box gyms with additional resources with regards to lifeguard for the swimming pools. That's really the main thing. Maintenance, again, driven by the footfall, the increase in footfall and consumables, and then the refurbished clubs. We've refurbished more than 80 by now over the last 3 years, which is always essential for our members and growth. That's the associated cost around it.
All right, thank you. And a part of Abdulaziz's question was about self-service concepts. Is that something you are considering?
Self-service.
Self-service
Initiative to reduce cost.
I think we are already optimized. I think the positioning of our brand is not a self-service brand. We have the Express, which is less on the stuff, but the big box format is more of a premium brand and offering, and people do expect this, and that's why we have a strong brand equity comparing with the competition. And I don't know if it will be the best option, but we always think of alternatives. For example, the automated gates that we've implemented over the last 3 years. This was an improvement in terms of capex and technology, which reduced the number of staff at the reception because now it's fully automated. So we keep on doing these initiatives and improvements, but at the same time, we don't want to compromise on the service level.
Thank you for that. We'll take one more question from the Q&A box before moving back to raised hands. So Ariba also asks, can you share your current market share in the total gym market?
So there is no accurate measure in terms of market share. We try to get some studies from the likes of Nielsen, but still no one is really following because the market is fragmented. 60 to 70% of the market are single unit owners. So if you think about it in terms of number of centers, we are roughly 9%. This is based on the published number from the ministry. We are 9% roughly in terms of number of centers. In terms of number of members, I think it's around 25% plus minus, based on the total number of gym goers, and if you compare it with our number of members. But again, this is not accurate number. This is the best, I would say, guesstimate available in the market.
Thank you for that. Moving back to raised hands, we have a question from the line of Tahir. Tahir, your line is now open. Could you please unmute yourself and go ahead?
Yes. Good day, gents. Am I audible?
Yes, you are.
Yeah, thank you. Thank you very much for the call. Maybe just one ask, if you can share the presentation with us ahead of the call, that would be much appreciated just for us to follow, because I appreciate there's a lot of new level of disclosures, which is always appreciated in the presentation, but that also helps us to manage our questions accordingly. So that's just a small ask, if I may. My question, gents, is just really on this like for like, non-like for like trends. I mean, clearly the market, judging by the share price, Mr. Asim, is not liking this set of numbers in general. And I think there continues to be some high level of uncertainty or earnings estimation risk because you are still in that heavy investment cycle. And based on your statements, we're just maybe kicking the can down the road in terms of maybe pushing some openings from Q4 25 into H1 26. So I think my key question here is, how should we think about a sustainable Leejam, or if you want to call it a Leejam 2.0, a business with 250 centers? What kind of margins do you think is sustainable for such a business? That's number one. And number two, judging by the presentation and the slide you've shared on the LFL versus the non-LFL, I can see that the non-LFL centers are almost at 50% of their revenue capacity versus the more mature gyms. But I didn't catch the EBITDA margin on the non-LFL gyms. So maybe you can elaborate on that point, just for us to understand where is the business heading clearly, into next year and the year after. I hope I'm clear on that.
Assalamu alaikum. This is Abdullah, CEO of Leejam. In terms of EBITDA margin, I think what the company right now is putting more focus on is sustainable growth over the next 3 to 5 years. The company has gone through a lot of expansions since 2020 with a lot of market dynamic changes since then. Now we started a strategy exercise which will reveal where are we growing and how we will grow in the next 3 to 5 years. I think that will reveal a lot of information and some fixes around, which is normal in our business. I think the main focus that the company, the management board strive is to ensure a proper customer experience. Right now, it is in the heart of what we're doing, but shifting from mainly to be a sales-driven company into more of a customer-focused experience. We believe with doing this, this will naturally going to have a positive impact later on retention, customer growth, and etc. As we speak, maybe I've already mentioned this in my opening remarks, that we are refocusing on quality of services with changes in our club structure to ensure alignment between staff KPIs and customer experience. As an operator of around 230 gyms, that takes some time, but the company is determined to ensure that we are always on our toes. The company has, over the last year and a half, has invested heavily in technology by receiving customer feedback, areas of improvement, and the company also invested heavily in technology and will continue to do that in the future to drive our growth and to drive our decision-making going forward. Yes, I understand today that there are some pressure on margins, but the company will look for medium to long-term sustainability rather than short-term gains that could jeopardize the overall investors' returns. Addition to that, the next 3 to 5 years will not only focus on Fitness Time as a brand. Part of how we will think about the growth is to see growth in other engines, which is currently under review and development. It will be revealed on the right time once the strategy exercise is finalized, ensuring that the core is well protected and growth is going in the right direction. But again, utilizing the huge number of our customers, more than 530,000 customers, to create and to offer additional services as we move forward. I mean, at the end, yes, we focus on EBITDA, we focus on short-term gains, but our main focus is actually medium to long-term EBITDA and growth. And we'll have a better understanding and insight, inshallah, once we have finalized the whole strategy exercise. Thank you.
Thank you for that. Our next question comes from the line of Yevgeny. Yevgeny, your line is now open. Could you please unmute yourself and go ahead?
Hi, it's Evgeny from Jefferies. Thank you for taking my question. You mentioned some issues with utilization related to stretched capacity, parking. Can you please elaborate on how you're addressing this, and how does it affect your selection of locations and new openings beyond the 250 target? Can we maybe see you starting to grow more outside of Riyadh, given these parking issues? And sorry, a small technical question. Are you planning a capital markets day sometime next year to present this new strategy? Thank you.
Thank you. The parking issue that was highlighted, I mean, it happened in some locations, especially the old locations. As members grew, some of them had some constructions around them, so affected the parking capacity, which resulted in slower than expected renewal or new sales. Now, for the newer locations, yeah, this is already considered. I don't think we have an issue. I mean, for example, one of the locations we already have a couple of locations with basement, but we were trying to avoid it over the historical period because it's the additional costs that associated with it. But newer locations, some of them we also included basement. So the issue is actually that comes on and off, depending on which location you're talking about. We'll see, how we work around these issues as we move. The other question was around the
Capital Market Day.
Capital Market Day. I think there is no yet clear date, but we will definitely announce it. Most likely end of Q1, plus minus.
Thank you, panelists. Moving back to the Q&A box, we have a question from Suleiman asking, does the company intend to sell off some of the non-profitable segments like swimming academy, basketball academy, etc.?
Thank you. I mean, these academies are really tiny and does not, represent something significant out of the total business. And most of these are pop-ups within the existing network. So like additional revenue stream rather than a standalone business. I mean, we have 1 or 2 locations as a standalone, but the remaining are pop-up within the existing location. So it's not really a standalone business to be sold or splitted.
Clear. Thank you. Musa asks, out of the 3 billion share buyback, how much of that has been executed so far?
Can you repeat that, please, Ryan?
Sure. So Musa asks, out of the announced 3 billion riyal share buyback, how much of that has been executed so far?
Before that, I think on the academies, I think generally on the investment side, we are in the process of reviewing those investments as they already passed 1 to 2 years from the time we've initiated them. So we will update you as we move. On the share buyback, we started executing since yesterday. As you know, there are limitations from the regulation with regards to the total number that you can execute on daily basis based on the average of the last 5 days and so forth. But we started since yesterday. I think it will gonna take, as per the AGM approval, it's 18 months, but even practically speaking, it will take not less than 6 to 12 months to execute as we have a very specific target price in mind.
Clear. Thank you. Elisa asks, how many of your branches are loss-making currently?
On a gross profit level or cash level basis, we don't have loss-making.
All right. I'll take one more question before moving back to raised hands. Suleiman is asking, is the 20 to 25% earnings growth guidance for Q4 25, or is that on a year-to-year basis?
Oh, the 44% was for Q4. Now you do the math and you will get the total year margin.
I believe he was talking about the earnings growth, if it was for Q4 or full year, 20 to 25%.
No, it was Q4 specific.
It was for Q4
Yeah.
year on year then.
I mean, total year would be a miracle.
All right. So that'll be year on year for the quarter for Q4.
Yes, year on year.
Clear. Clear. So moving back to raised hands, we have a question from Taha. Taha, your line is now open. Could you please unmute yourself and go ahead?
We cannot hear you, Taha.
Yeah. Thank you so much, management. So just I think you clarified. I also had a question that the fourth Q numbers earnings was for year on year, or were you talking Q on Q? I think you clarified that it's year on year. Apart from that, like I think just wanted to reiterate, what is your sense on the sustainable margin? I think someone asked this as well. That obviously in the medium term, barring this last 2 years, you used to have a decent margins, EBITDA margin of around 53%. Net margin used to be around 25%. Obviously, last couple of years have been a bit rough due to ramping up, but sustainable, like 1 or 2 years down the line, post this new strategy, what kind of a margin would you be happy with, or would you target, which in your view is a sustainable margin for us to sort of think about the company? And secondly, related to that, on obviously, I guess you'll release it next year, the new strategy. But if any color that you can provide, are you thinking that you will continue to grow aggressively, or you want to have a lower volumetric growth in terms of number of gems? How are you thinking about that? Thank you.
Thank you, Taha. For the standalone business of Leejam, which is the core business fitness time, I think the margin that you saw on the like-for-like was in the range of 50 plus minus. It really depends on the volume. If we sustain those volumes on the existing network and we grow the volume for the new network to be in line with the existing network, this should be the line, the expected margin going forward. But this is, again, question of demand, increase of penetration, and so forth. In terms of branch opening, I think we are leaning toward 15-20 annually over the next 3 to 5 years. But again, the final number will be announced in the strategy. But this is more of the number that we are leaning toward, given the fact that we would have been opened 100 gym by next year. So I think those 100 needs time and focus. But again, we are flexible. If the market have positive signs to grow, I think, and this is the best thing to do for the company, definitely will grow. I'll give it to the CEO for be on the strategy.
Yeah, sure. Thank you, Asim. Just going back to the target, I think the company aims to get the best targeted EBITDA as possible. That is sustainable over the long, medium to long term. With regards to openings, as Mr. Asim mentioned, we will be opportunistic from time to time. And we will, I think what we have in mind is not how many branches we open. I think the quality of the locations and the ramp-up period that it would take to turn to reach the break-even point. I think this is where we focus more on the quality rather than just the quantity going forward.
Thank you, panelists. Moving on, we'll be taking a question from Ankar. Ankar, your line is now open. Could you please unmute yourself and go ahead? Ankar, could you please unmute yourself and go ahead? All right, well, you're more than welcome to try again later. We will be taking the next question from the line of Abdurrahman. Abdurrahman, your line is now open. Could you please? Ankar is back. So yeah, please go ahead. Yes, Ankar, you are.
Thank you for the opportunity. So my question is basically, I think just to understand it clearly, right? You are investing more customer satisfaction, trying to address the parking issue in some gyms and everything else. So should we expect more investment? I mean, so your sustainable margins going forward, even if the gym openings slow down, would be lower than what they were expected to be, let's say, a year back because of these investments? Or these are, because I mean, you've been investing in customer retention, better customer service for the last few years, right? So what is new this time in terms of the investment in this element? And does it impact the sustainable margin question that has come up in different ways going forward, right? Even if the gym openings slow down.
Thank you, Anja. Can I respond?
Yeah, sure.
I think investing in the customer satisfaction is a result of proper cascading of KPIs to gym staff and alignment of KPIs with the overall objective of the company objective. I think this is what we mean by customer service, ensuring that our employees are up to date when it comes to proper training and customer facing, and ensure that we have a proper customer journey going forward. In addition to that, I would also add that the company also will invest over the next 3 to 5 years again. Part of the expansion is on the branding or the rebranding of our gyms in terms of creating communities and creating additional services that will keep customer engaged. I think this is the overall direction that we are heading into, ensuring a proper quality, which we believe with time will lower our dependency on continuous and frequent discounts and show the value of our gyms to our customers. I think that's the way that we think about sustainability. Definitely, EBITDA margin will always be in the top of our mind by some product mix changes, by some value and revenue and etc. And I hope that responds to your question, which is very critical and important for the company to still and continue to compete in the future in a proper way.
Thank you, panelists. Moving back to Abdurrahman Al-Ubaykan. Abdurrahman, your line is now open. Could you please unmute yourself and go ahead?
Hello, gentlemen. Am I audible?
Yes, you are.
Okay, great. So I just had a question regarding the upgrades. We know that you've essentially upgraded a lot of your pro gyms to the normal red big box format. So I just want to understand from these upgrades that we've seen or what you've shared, how many of them were, let's say, organic upgrades versus the inorganic upgrades that came from the changing of the format from pro to the red format?
Thank you, Abdurrahman. I mean, the number we've shown obviously includes everything, because at the end of the day, customers, if they are not happy, they wouldn't renew. So the number includes whether these clubs were upgraded from a pro to FT or a regular upgrade. This includes Express to Pro, Pro to FT, FT to Plus, and vice versa. So the whole network.
Thank you for that. Our next question comes from the line of Sumaya. Sumaya, your line is now open. Could you please unmute yourself and go ahead?
Assalamu alaikum. Ya'atikum al-afiyah. Thank you guys very much. I had a question regarding the, you mentioned that your costs went up in G&A, SG&A, due to investments in digitalization, which is understandable, but also due to investments in recruitment. So these are sticky costs. I just wanted you to elaborate on this point. I may have missed it earlier. And then going forward, should we expect this to increase or to be maintained at these levels? That is one. The other question is regarding the National Day offers and discounts. I just wanted to understand how you account for those. So when you offer a discount, what you book towards the revenue and what is booked towards the expense. So if you could just elaborate on that point as well. Thank you very much.
Thank you, Sumaya. With regards to G&A, I think we will have a better understanding. Definitely, the company seeks optimization and efficiency as it moves forward. And any G&A that is not investable at the end of the day, the company should always think about proper reduction. We see G&A as an investment. However, I think with the new strategy, we'll have a better understanding and a proper operating model that will serve the company better, not only Petrus time, but also other growth engines that the company will think about as a result of the strategy exercise. I think we will have a better understanding once we have the strategy finalized, but definitely the company, the board, management, one of their KPIs to ensure a proper efficiency going forward, and we've already done some work around that. I will continue to ensure we enhance optimization as we move forward. What is the second part, Sumaya?
The sales campaign.
Revenue versus cost.
Yeah, I mean, as you know, we every month we have a different promotional campaign. What matters is the net realizable price. So September is not so different. Anything that we spend on social media would be sales and marketing expense. But at the end of the day, the net realizable price or the net price paid by the customers is the one that will be booked in the revenue. If this was the question, I'm not sure if I did it right.
Well, thank you, panelists. As we've reached the allotted time for this session, that would have to mark the final question for the day.
Yeah,
And on behalf of please.
Can we take Usman and then one more question from the chat or Q&A box?
Sure, of course. I mean, if you'd like to carry on, we can do that as well. I believe Usman's hand's not up. I see he's on the list, but just in case, Usman, I'm gonna unmute you and please go ahead. Usman, if you had a question, could you please unmute yourself and go ahead? You don't have a question. Okay. Well, we do have a question from Mohammed Saad. So unmuting Mohammed. Could you please go ahead, Mohammed Saad?
Yeah, thank you. So my question is with regards to your fourth quarter guidance, like as per your overall full year number of center guidance, new stores in the new centers in the fourth quarter will be in the range of 3 to maybe 11, around 11. If, for instance, 11 new store centers are opened, how will you possibly end up with a GP margin of around 43%? Like these new 11 new centers should exert a lot of pressure on the GP margin, if I'm not mistaken. That's my one question. My second question is with regards to the finance cost in your third quarter. It seems your finance cost was quite elevated, and if I reverse back using the numbers that you shared in your presentation, it does not add up. So was there some one-off element in your finance cost in the third quarter? These are two of my questions. Thank you.
So thank you, Mohammed. Q4 margin, again, it has certain assumptions with regards to the sales that we will make during the quarter. And as a result, that was the expected gross profit. Again, it could go up or down, definitely depending on the sales. In terms of number of openings, it really depends on how much the final number of openings and when. If you open it in the last month, for example, like what happened last year, it wouldn't have that much of big impact on Q4 itself. So, and then always we do a pre-sale for any new opening. And as you can see, the non-like-for-like improved versus last year because we extended the pre-opening campaigns for all the new centers. And some of the centers we already have by now 1,000 members, for example. So it really depends on which center, when it will open, and likewise. For the finance cost, there was an increase in utilization of loans, which resulted in an increase in, unless you are comparing the cash flow finance cost versus the P&L. If that's the case, the cash flow finance cost includes the capitalized portion. You know, as per the standard, if there is a finance cost associated with a new opening during construction, you can capitalize it. That's why the finance cost in the cash flow, like paid, is higher than the finance cost in the P&L. The same goes for leases.
Can we get now the one question from the chat?
Yes.
I think the finance cost was related maybe on a year-on-year on a Q-on-Q basis in the income statement.
So income statement, yeah, I mean, the increase is because of the higher utilization of our loans. As well as, let's not forget that the finance cost includes finance cost on debt, in addition to lease, IFRS 16, which is more accounting related than actual IAS 19, obviously. And then you have the buy now, pay later. We park it there because for us, it's a financing product.
Thank you for that. So from the Q&A chat box, there are a couple of questions asking about the rental freeze. So I'll be asking that if you could please provide any insight on whether the rental freeze has any impact on Leejam and what could that impact look like?
Thanks for bringing it up. Overall, I think there is still some ambiguity in the platform. There are some exceptions. But what I can confirm is that if it is a land and it gets expired, which is the case for most of our big box format, the landlord has a right to actually come up with a new contract. Instead of leasing the land, now he's leasing the building because by law, he owns the building. So with that, I don't think there will be a drop. As a matter of fact, I mean, it will be supply demand now. I mean, what's the alternative and how much the landlord wants to offer in terms of lease. But the bottom line is that if it is express format where you leased a building, this will be freezed. If it is a big box format where we leased a land, the landlord has a right to change the contract to a lease of a building because now it's a new thing. And in that case, there's no freeze. He will deploy his own annual rent based on the supply and demand dynamics. But overall, the two laws have a very positive impact on the market for us and I think all retailers.
That's very clear. Thank you for the clarification. We have a question from Abdullah asking, how many centers are currently refurbished versus the ones that are not refurbished?
So I think the remaining number of the total network is around 35 plus minus. Everything else is either refurbished or new.
All right, thank you for that. Isa asks, what is the churn rate during 9-month 25 period?
Churn rate of what?
What's the churn rate 9 months into 2025?
You mean, again, we do not understand the...
What does the 9 months has to do with the churn? Sorry.
That's, I was reading his question as is, but we can move on to the next question.
We don't usually disclose the churn rate, but I mean, what we always disclose is that roughly 25-30% of our monthly sales are renewals, 30 to 40% are rejoiners, someone who has been with us historically over the last couple of months or couple of years, and the remaining percentage are totally new sales to us.
All right, thank you for that. So a question from Abdullah asks, despite the price increases across various subscription periods, revenue per member declined year on year. In addition, member growth this quarter was lower compared to the past 2 years. Could you elaborate on the key drivers behind these two trends?
I think it will be a little bit misleading because obviously, one, there is a time lag. So if someone bought a 12-month subscription last year, he will be still counted for in the revenue. But so one is the product mix will make a difference. As we sell shorter term, higher yield, revenue per member and per center will be higher. So that's number one. Product mix will have an impact. Brand mix will have an impact. Express format has a lower ticket price, and accordingly, revenue-wise will be lower. So product mix, even gender mix will have an impact. So as we all know, female centers in terms of utilization and penetration are lower. And as a result, their revenue per center is lower, their margin is lower, given the fact that the centers are less utilized comparing with the male, given the historical reasons behind it. So these are the main reasons why the revenue per member or per center will fluctuate depending on which season and which product.
Thank you for that. We have a question from the line of Fahad Irfan, the host. Fahad, could you please go ahead?
Just one question on the fourth quarter guidance. So in Q4 24, I believe there was some one-off income, maybe around 11 million-ish. So this 20 to 25% growth is normalized. The expectation of 20 to 25% earnings growth in Q4 25 is normalized, or is on top of this, including the other income for one.
Yeah, I think normalized. Yes, I'm trying to recall. I did the calculation. I think it's normalized.
Okay, so absolute growth would be a bit less.
Sorry, the line was breaking.
Can you repeat can you raise your voice a little bit, Fahad?
Yeah, so I'm saying, so basically the 20 to 25% increase that you're expecting is on normalized earnings. This should be excluding some of the one-off. Can you quantify the one-off that was there in Q4 24?
I didn't recall, to be honest, the one-off last year, but to your point, the increase is expected on a normalized basis.
Can you recall it, the normalized earnings?
Sorry, Irfan, we don't have a number for now. So what the CFO just answered you saying whatever guidance he gave based on normalized numbers.
Thank you.
I think it was 100 million for the quarter.
So I would, Ibrahim, do you have any question we did not touch on? We will get the last questions and then we will conclude.
All right, sure. Let's go for the last question. It was a request for a clarification from Saud asking on how you expect that you would have, or how you were guiding for 44% gross margin in Q4 and also having the same gross profit margin on 25 to 2024.
Again?
So Saud was asking, I'll read it as is. Saud was saying, can you please explain how are you guiding for 44% gross margin in Q4 25 and also FY 25 will be in line with FY 24 gross profit margin?
No, I was referring to Q4 specifically, not the total year.
Okay.
So that's the guidance which I give for Q4 specifically, and I said revenue should grow by 11 to 13% versus last year. The margin should be in line with last year, and bottom line should grow by 20 to 25% versus last year.
All right. Well, thank you, panelists. Thank you, participants. That would have to mark the end of our session. And on behalf of Al Jazeera Capital, we'd like to extend our sincere thanks to Leejam's management for their time and the presentation. And a thank you to our guests for taking the time to join the call. Management, the floor is yours for any closing remarks.
I would thank everybody for joining, and for those who did not answer any questions, you guys are welcome to email us at IR, and we will do our best to answer you as soon as possible.
I'd like to thank you, Raheem and team for your efforts, and also I'd like to thank participants for their valuable questions and insights as well. Thank you.
Thank you all.
Thank you, management. Thank you, management. It was our pleasure. Thank you, everybody. The meeting's now over.